Oh, that's some good coffee. Well, today's video, guys, we're going to be looking at index investing and ETFs versus picking individual stocks, the pros and cons of both, and which one might be the right one for you. So stay tuned. Now, if you don't have the knowledge or the time to do research in individual stock picking, does this mean you shouldn't invest at all? That's not the case. There is another way of investing which is completely passive and it takes very little effort on your behalf. Even though primarily on this channel I will be discussing value investing and picking individual stocks and companies where there is a lot of future growth where you can potentially outperform the market. We also have to talk about the elephant in the room.
First, we need to acknowledge the elephant in the room. Francine.
Which is indexes. Now, what is an index? An index is essentially a group of companies that represent the market or an industry. So for instance, the Dow Jones 30 represents the 30 most significant companies in the US, as well as the S&P 500, as I've mentioned on previous videos, represents 500 companies within the US economy. Now that you know what an index actually is, how do you go about investing in one? This is what's called an exchange traded fund, or known as an ETF. An ETF tracks an index. So you get different entities that have their own ETFs, like Vanguard and ProShares, just to name a few. The amount of ETFs one can invest in is actually pretty exciting. There's over 6,500 different types of ETFs you can invest in. ETFs that track water, that track gold, but there's even more niche ETFs like the VIX, which is the Volatility Index.
The VIX Volatility ETFs held up remarkably well, like most. There's 2,400 ETFs, Bob.
And that basically tracks the amount of volatility in the market. The more volatile the market is, the more this ETF goes up. So if you think the market is going to be a bit more volatile in the future, then buying the VIX, for example, will be a good investment. Personally, I'm investing in water ETFs at the moment because in the future, water is going to be quite the hot commodity. Does Mad Max ring a bell? The reason behind why investors pool money into indexes is because they're confident that this index they're investing in will grow in the future. So for instance, if you're investing in S&P 500, you're confident that the US economy is going to grow and prosper in the future. Likewise, if you're investing in a gold ETF, for example, you're confident that the commodity of gold is going to increase in value in the future. Now let's have a look at buying into an ETF versus picking an individual stock. The pros and cons of each and which one might be better for you. So on one hand we have the ETF. Now ETF is completely passive, requires minimal amount of time and effort or even knowledge of the stock market. It diversifies your money and spreads them across a broader index of companies. With this said, having your money super diversified means that your risk is minimalized, and therefore your returns might not be as great. You are probably looking around about a 7% per annum on average, which basically means you're just going to be matching the stock market every year. Now this is still a respectable number given that your average savings account might not be giving you these same type of returns. On the other hand, we have individual stock picking, which would require some additional upfront knowledge, a little bit more of a skill set to be developed. But in the long run, individual stock picking is by far the best way to outperform the market. I can't tell you how many times I've got emails off my portfolio stating that I have outperformed the market just from individual stock picking. Picking individual stocks is definitely the more aggressive way to be invested in the stock market, especially during times of recession where if you own an ETF, the ETF would be in a recession essentially too. But picking individual stocks, you might have found a company that is actually thriving in a recession. Kind of like the 2000 dot-com bubble or the 2008 Great Recession that happened. There were still some stocks there that were outperforming the market during times of a recession. Kind of like the economic recession we're in right now, where we see big tech companies absolutely killing their revenues because everyone is staying at home. So if you were invested in the S&P 500 right now, sure, you would have had a decent amount of return. But compared to being invested in Amazon or Tesla, who have been making profits and beating their earnings estimates.
Check out this huge move in Tesla. That stock is up nearly 12% after its own big beat. There it is right now, 11%. You're pushing $650 in the aftermarket.
You can see how individual stock picking would have been the better option. At the end of the day, it just depends on how serious you are in investing. If you're just finding a way to make passive income and you're in your 20s, you have time to amount to the 7% per year in the future for the next 40 years, then by all means invest in an ETF. It's completely passive, less effort. However, I would not take that same attitude towards individual stock picking, because if you're just thinking a stock is going to go up in the future and you don't have the necessary skill set to do research on the company and understand the business and take the time to do that, then what you're doing is not investing, it's just gambling. Welcome, you have made it to the end of the video. Thank you so much for viewing, you guys. If you found some value in it, hit the like button. It always helps out the channel for the YouTube algorithm, and do consider subscribing as well. Comment down below as well if you are looking at investing any ETFs that might be on your radar. Hopefully there was some value in here that can be shared. So yeah, do consider subscribing as well. And when we do hit 100 subscribers, I am doing a giveaway. And yes, I'm just excited to share this investing journey with you. So until next week, cheers.